My wife will say to me, what'd the market do today? And I tell you honestly, some days I'll tell her I don't know if it was up or down. I don't even look at it. I think one needs to make one very basic decision. Are you going to be a trader or are you going to be an investor? And you get it, right? Are you using a 10-day moving average or a 500-day moving average, right? And if you're an investor, like we own British Petroleum, why? I need a life, I need to get a life. So sure, it goes up when oil goes up and it goes down when oil goes down, right? Do I pay any attention to that? No, because I'm buying what I perceive as an undervalued asset. So I think all this macro stuff, I find impossible to get a handle on. You've got the Fed, you've got Iran. I read a thing the other day, the guy called this a K-shaped economy. I don't know what that is. The election's coming up. They knocked down defense stocks today. Why did they knock down defense stocks? Here's the reasoning. Because the war is unpopular, and that could put the Democrats in office in November, and they're going to cut the defense. What? Really? I think investors would probably be better off doing less macro analysis and working more on a technical approach. Let stock tell you what to do.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, I'm super excited to share with you a conversation with Tony Gallea. Tony's the CEO of Working Profit. He had a 45-year career at Morgan Stanley, fantastic experience in the financial industry. Now, writing a newsletter to help individual investors identify undervalued opportunities. He literally wrote the book on contrarian investing. And I read his book, Bulls Make Money, Bears Make Money, Pigs Get Slaughtered, early on in my career. And it really helped inspire me to focus on investor decision-making, psychology, and process. We have a fun conversation today talking about valuations, talking about the AI trade, talking about opportunities outside of AI, his introduction to technical analysis, and how he used to use the Mansfield charts, among other tools, to round out his understanding of the financial markets. Please enjoy this wide-ranging conversation with Tony Gallea of Working Profit. Tony, it's so awesome to finally meet you. I've read your works. I followed your work for many years, and it's a pleasure to chat with you today. Thanks for coming on the show.
Well, thank you very much, David. And I equally admiration of your work and your career.
You're kind to say that. I have so much I would love to ask you, and I'm thankful for the opportunity to do so on behalf of my viewers and listeners. Sure. First thing that comes to mind, obviously in terms of the current market environment, we're all kind of struggling with the AI journey, this AI, sort of theme that is evolving over time. You had a fantastic post recently on LinkedIn with the what I would call the pig through the python analogy or the metaphor. Yeah. Can you talk through what that actually represents and how we should be thinking about maybe growth rates and potential growth rates today for these AI names?
So thank you very much for that, David. So just in the way of background, I did my first work in AI 10 years ago, and I use Parallax Financial, who not far from you, Chris Kaufman. You want to interview him, not me. He's the expert,
Sure.
But so I've been a practitioner in AI, back propagating neural networks for 10 years. And I have AI enabled machines and all of that kind of thing. So I have a long experience using AI, and I'm less excited about it than other people. And let me just give you my view of it. AI is not a panacea. I use AI in my work. I liken it to a very eager, unpaid intern who's always trying to prove itself, Give me this and it gives me this, and can I give you more, But what we're witnessing right now is part one. GPT came out, and suddenly the whole thing exploded. And then a real rush. I've never seen anything like it in my career. There are many parallels to 2000 and the internet to lead up to the 2000 top. I see some of that rhyming today. Who knows? But people need to understand that this is not going to be as great across the board as they think it is. There's going to be a lot of winners and a lot of losers. I think eventually AI will be commoditized. Copilot or whoever you want to get, it'll be commoditized. And I think there's enough error in AI that it can't be entirely trusted. And so right now, everybody wants to find the next NVIDIA. I wish them luck. I think it's pretty tough. Everybody, should I be buying it or selling it, or what should I be doing with it? Microsoft is down 30%. There's concerns
Yeah.
about their capital spend, right? It's a place of landmines. And I think best left alone until things sort themselves out. Right now, it's semiconductors. That's the pig through the python. Once they get through data centers, but who knew data centers would get pushback? And so I think it's a very much of a mixed bag, and people need to be cautious.
It's so funny. I love that analogy of the unpaid intern because I've often described it to people as having a junior intern at Fidelity back in the day. And you gave them things expecting them to come back with some real rookie mistakes, and you would often have to correct it. And it was sort of like it was a learning experience for them. And eventually you got something out of it, but you never expected them to come back with gold star work. And I think that concerns me that a lot of people are expecting a PhD level of awesome from these tools. And it's really more, I mean, it still makes rookie mistakes so often, right? And so you do have to think of it as a dialogue. So given, what we're starting to see, you sort of alluded to this, right? That you're seeing, some of the early names had done remarkably well. You're now starting to see names like NVIDIA, Broadcom, obviously coming down quite a bit after Microsoft and Meta and others. Now we're sort of kind of going further up the chain in AI. So how do you think about, and particularly given your experience in the industry dealing with bubble-like, events, and you alluded to the tech bubble, where do you see that we are in this sort of evolution of the AI theme? Do you find reasons today to be optimistic that movements we're seeing that are corrective now are just kind of short-term bumps on the road versus what would tell you, okay, this is now coming crashing down for whatever reason? Like, how do you differentiate that kind of thing?
Well, I don't think it's difficult. I think if you go back and look at the history of 2000, what happened, you had 4 years where you built up to the top in 2000. And let's just think about that for a second. You had the internet, right? Well, everybody had it right. The internet was going to be the next big thing, no question about it. And so companies that got involved in the internet had it correct. It was something you wanted to get going.
Yeah.
The problem is they didn't make any money at it. It was like, at what price? Cisco took 30 years or something to get back to its 2000 high, right? So you can have a great idea and it can be perfectly accurate and not make any money in the stocks. And I think that's the risk here, that we all know that AI is here to stay. You can lose your money in those stocks, even though they're going to be ultimately correct.
And I think that's a great point, right? It's separating the theme, right? The technology, which certainly seems transformative, versus whether specific companies are a good buy, right about now. Where, when you think about the spectrum, particularly in terms of AI infrastructure spending, that's been one of the biggest, I think, I guess warning signs for a lot of investors is just seeing the magnitude, the amounts, the number of zeros that are being thrown into infrastructure today, with the expectation that becomes future profits.
And
where are you on the spectrum between all this spending is fruitless and it's really not going to be profitable for so long that it's kind of a train wreck just waiting to happen, all the way on the other end of the spectrum is it's going to be so profitable that this amount of money is nothing compared to the future profits? Where are you on that spectrum, and what are some of the guideposts you would be watching to sort of figure out what ends up being the right call here?
Well, I think we've had a very recent example that rhymes with what's going on in this. I think history does not repeat. It actually rhymes. Yeah, I've seen that before. Not quite, but I've seen it before. We have a perfect example in front of us, electric vehicles. The automobile companies saw that as the next big thing. And through billions, I don't know what the write-offs now, David, you could probably put 40 billion, 100 billion they've written off in EV investment.
Yeah.
It's not that the idea was a bad idea. It was, no, it was exactly an EV. They threw billions at it because they had no choice. If you're David, you're the chairman of an automobile company, you're going to ignore EV 5 years ago? You can't. They threw all the money at it. It came a cropper. They all wrote it off. I think the same thing is going on here. I see this. These companies cannot afford not to take the chance. They can't be left behind.
Right. No, it's 100% right. And so one of the other themes that I've been talking a lot about recently, Tony, is just there's such this fixation in technology, and justifiably so. 40% of our benchmark or so, right, is just in tech. And then if you add the other kind of tech-like things, it's probably about half of our benchmark. But you're also seeing a number of banks doing remarkably well, performance-wise. You're seeing a bunch of industrial names doing pretty well, some other sector, healthcare and other sectors as well. How do you think about, in terms of like overall positioning, or in terms of like where to focus your attention? How do you think about some of the opportunities outside of AI? And particularly, we've seen a lot of market breadth indicators looking pretty strong recently, suggesting that there are a lot of stocks doing remarkably well, even when some of the semiconductors are struggling. So how do you balance sort of this, impossible to ignore theme of AI versus the fact that there are a lot of other opportunities that seem to be emerging?
Well, full disclosure, I don't own any AI related equities. None, zero, nothing. The closest I get is IBM, which I don't really think, it's not really an AI, but it's AI and it's quantum and it's software and all that.
Yeah. Yeah.
I don't own any of it because I'm kind of an old fashioned green eye shade, assets at a discount price, So for me, I think of all these big moves we've seen in AI and technology. In my brain, constantly, I'm going source of funds, use of funds, source of funds, use of funds. And so I see vast areas of the market. I mean, I'm having a good time with it. Vast areas of the market that have been knocked down as a source of funds for AI and technology investment. Why in the world do you want to own Target when you can own NVIDIA? That kind of thing, right? Except Target's gone from 90 to 135, right? So I think what we've been in, I think AI and technology has sucked all the capital out. The money to buy these things has to come from somewhere, right? Sucked all the capital out, and now the capital is beginning to wash back up. And this is why I think you're seeing staples and industrials and really boring kind of nothing stocks starting to really perform. So I think that's source of funds and use of funds. That's the thing I always try to keep in my mind about these things.
How, with this concentration in our benchmarks, how much of a factor would you say index funds, sort of broad market ETFs? I mean, we're at an unusual place. There's certainly a unique part in history where there's such a concentration of assets in index funds, which necessarily have to have exposure to this huge sector with all these key themes. How much of an impact do you think that is making in terms of how we're valuing these companies, or just the way that they're being bid up fairly aggressively recently?
Well, you go into an index and there's a natural group of buyers that are going to pick that stock up, In my case, I don't own any indexes or any ETFs. I'm a pure stock picker. So to me, it's a different thing. But to the extent, be careful. To the extent that these things are dominating these indexes, one of the things that I've wondered about, and I would guess you have too, is if AI and tech rolls over, where's the new leadership?
Yeah.
I don't know that there is any, and that could put this market in trouble. And if you're just invested in broad indexes, you're gonna have to deal with the downside of that.
Tony, you literally have written the book on a number of amazing topics I would love to dig into, and I wish we have more time, and I hope we can continue this conversation down the road. But one of the books you've written is on contrarian investing, right? And just looking for stocks that are, beaten down and all of that. If we could start and kind of pivot to that, how do you differentiate between something that's just unpopular versus something that's truly undervalued? What are the things that you look for that tells you this isn't just going down because it's no longer something we should consider, versus this is something that's now getting to the point where its value is greater than the market is telling us?
So it's a really great question. It's the nub of the problem, isn't it? You get caught in a value trap,
Yeah.
So I think there's a couple of pieces that we follow, and I do it this way, David, because I learned it. I don't have to do it this way. I just learned it, First of all, I want to see a mispricing of what I believe are the assets of the fundamental value. Everybody says that, but I'll use Target again as an example. When I looked at Target last year, I kept looking at it and saying, the real estate, and I did the math. I sat there with and I did the math, and it was trading pretty much for the value of its real estate, like the retail is free, right? Okay, so that's in this pricing of assets. Then I said to myself, yeah, but is this a value trap? because the retail, they're not going to sell the real estate, and if the retail business goes bad, you got a value trap, right? You're stuck in it forever. So what we like to do is get a catalyst. So first, a mispricing of assets, right? And then a catalyst. In my case, I look first at activists. We're following 50 different activist campaigns, of which about a dozen have hit the buy button, right? Where you've got a near-term catalyst that's going to move this thing. And absent that, a friend of mine yesterday, he used to run a hedge fund. He said, I'm looking at these oil stocks, and I said, there's one I like, and it hasn't moved in 5 years. And I said, either because the underlying has been declining for 5 years, or it's being misvalued, right? But it could sit there for another 5 years unless something changes it, a new CEO. So it doesn't have to be an activist. Could be some discovery, a new CEO, something, right? Technical types pick that up before guys like me do, right? I mean, you guys pick up the breakout. So I think you need not only a mispricing of the assets, the underlying, then you need a catalyst that's going to change it. And if I can't find a catalyst, what's the point?
Also, you've had a lot of success with what I consider sort of special situations, right? Spinoffs, corporate restructuring, those sorts of things, some of the parts investments. Why do those situations often create opportunities that the broader market often looks over?
That's a good question. It's like biotech. Some things are hard. Some things are just hard. Just hard. So, you're sitting there with your coffee or you're eating your nacho chips, you're looking at a stock. And some of the part, we just had Honeywell, some of the, and that was that, activists got involved and they said, you guys got to break this up because the aerospace is selling for the same PE as the humdrum business. And they were right. And so that made just like common sense to me, and they broke it up, and we've done pretty well with it. So I think that to get to that point, though, you have to then take the divisions and you got to separate them out as businesses and put PEs on, and then say, okay, if this breaks up, what goes to what, and what could the upside be to this? And do we take Honeywell Aerospace and do we put a PE on it like GE Aerospace, or what do we do with it? It's just fun. And a lot of people aren't going to do that work. I think that's a good piece of it. I mean, here, it take us 20 minutes to discuss it,
It's true. So it strikes me, Tony, as you're sharing some of these examples, just in terms of looking for, undervalued companies, looking for companies where the, sum is greater than the parts, or the parts are greater than the sum, or some mix of those. It seems to me that your process has to be pretty disciplined. Can you talk to us a little bit about what your process looks like? Is it truly sort of ad hoc, just looking for opportunities and just having a steady process of reviewing the evidence? Or is there, what do you do every day, every week to just try to make sure that you are able to identify these before everyone else does, which I would argue is probably the goal?
So I think the edge I have is my judgment, because I spent almost 50 years with this stuff, right? So, I sat in those boardrooms. I have a sense of what goes on, right? So I think the edge is judgment. But in doing it, what do I do on a daily basis? First of all, I troll the whole Value Line Investment Survey. So every week there's 140, God bless them over there. And I look through that. I've developed large language models. My interns, right? One trolls for activist news, and I get a daily report on activists, news, gurus who are worth listening to. Ideas come in that way, right?
Yeah.
That I follow just the news like everyone else does, but it is a constant trolling for ideas. It's got to be every day, all the time, and I'm just always kind of alert to something that may come along. And so I think in my position, because my subscribers expect ideas, I just can't take a month off and say, what the heck, I'm not going to do anything. I think it's good, though, for investors to develop a similar regimen. Once we find the stock, we buy it. And, I 1 or 2% of my main trading account, and then it might go up to 5 or 8% depending. But, I tell everybody, here's what I'm doing. You can follow it if you want. And then it's got to be monitored and followed. And that gets difficult because for instance, one of our names is IBM. IBM has traveled as a technician. You can handle this a lot better than I can. The thing has traveled 400. The major moves in IBM this year totaled 430 points, and the stock has moved $10.
That's right. That's a lot of movement for very little payoff at the end of that period, Tony.
It's hard. It's hard, right? So what that implies, though, is you better have conviction.
Yeah.
You better own an idea because you're going to get shaken out, right? All those biases, recency bias and all that, it'll shake you out. So you really have to have a firm conviction. If you don't have the firm conviction, just don't do it.
What I think for you've made your name in many ways as a stock picker and just your ability to identify opportunities among other things. But I'm curious, we're in an environment that feels largely macro driven in a lot of ways, right? Besides the AI theme, events in the Middle East. I know a lot of people when they're looking to click buy right now, in the back of their mind, they're thinking, but if the Strait of Hormuz recloses or whatever the next headline is going to be, all of this gets thrown out. So how do you think about the macro environment and its potential impact? Is it more just how shifts in things like crude oil or the dollar, whatever, could just impact the underlying businesses? Or is there some macro discipline? And how do you navigate in a period that feels so uncertain to so many?
So I'm a little different, and I don't know if it's weird or good, but that it is what it is, right? Like my wife will say to me, "What'd the market do today?" And I tell you honestly, some days I'll tell her I don't know if it was up or down. I mean, look at it. I mean, and I say that because I think one needs to make one very basic decision. Are you going to be a trader or are you going to be an investor? And you get it, right? Are you using a 10-day moving average or a 500-day moving average, right? You need to, and if you're an investor, right? Like we own British Petroleum. Why? I need a life, I need to get a life. So sure, I mean, it goes up when oil goes up and it goes down when oil goes down, right? Do I pay any attention to that? No, because I'm buying what I perceive as an undervalued asset. So I think all this macro stuff, I find impossible to get a handle on. You've got the Fed, you've got the Iran. I read a thing the other day, the guy called this a K-shaped economy. I don't know what that is. How do I learn that? Take in the Fed, take in the Iran thing. The election's coming up. They knocked down defense stocks today. Why did they knock down defense stocks? Because they said, here's the reasoning. Because the war is unpopular and that could put the Democrats in office in November and they're going to cut the defense. What? Really? I can't get my hands around it. So I think to move toward perhaps a little bit what you do, I think investors would probably be better off doing less macro analysis and working more on a technical approach. I think you would let the stock tell you what to do. So
Tony,
go ahead.
No, I promise our viewers I did not ask you to say that ahead of time, but I love that comment. I was taught, one of the things I was taught, forget the news, remember the chart.
Right? I mean, the price is all that counts, really. I don't care, what you and I say about it. The price counts. So I think people are, and I also think that many people are just maybe don't have a great capacity to analyze these extremely complex subjects and the interplay between them. I think that's why I don't do it. I find it very difficult to kind of square the whole thing. So I just kind of ignore it. I'm looking at the valuation and that governs my work.
Tony, it's funny because I would say 20 years ago, if I had heard that someone with the accomplishments that you'd made would feel comfortable ignoring the macro environment, I would think that was crazy. But then I spent a number of years at Fidelity filled with portfolio managers that had a very similar mindset, sort of the Peter Lynch, we're buying individual stocks, and the macro stuff's going to work out. And the dollar could be stronger or weaker, but in the end, the real value I'm providing is identifying ideas. So what I'm impressed with and what I hope everyone recognizes is you have a pretty clear-cut edge. You have a sense of where your edge is. You have a sense of where you're probably not feeling like you're adding a ton of value. So focus and build a process and build a portfolio around the things that you feel like where you have an edge. And I think that's great. That's great wisdom. You have mentioned a couple technical analysis, charty related kind of things. And again, I promise our viewers I did not proactively ask you to do that.
Whatever.
You offered that up, without threatening or anything. You had mentioned before we started the show about the Mansfield charts, and I'd love for you to share your early experiences with charts. Like, how were you introduced to them? Did you read the Mansfield charts, and what are those for those that do not know about these print books of charts that used to be printed and distributed? What was that like? I mean, tell me about your early exposure to that sort of practice, if you could.
So my first experience as an investor was in the mid-'70s as a civilian, and then I went to Shearson, Hayden Stone in 1980.
Okay.
And 1980, very important because the market was about to head toward its all-time modern lows, right?
Yeah.
Money funds would peak at 18%, believe it or not, right? And it was pre-digital. And so if you wanted to get research outside of your own firm, you had to wait for the S&P reports to come in. So they would come in paper format, and the assistants would load them into the books, and then the Mansfield charts came in. So, they were watching their expenses because nobody was making any money on Wall Street. And so the Mansfield charts would come in. It was like this, right? They were weekly charts, and the manager, because he was paying for it, would grab it. We'd line up at his office door. So the only thing you had really technically were printed charts that came in on a weekly basis. I was fortunate to come in the business at that time because then the IBM 286 came in, and this moved technical analysis, right? From handwriting charts. People would be handwriting their charts every day, updating their charts every day physically. People can't believe this is true. And then you got digital, and then all of this stuff began to move over to the computer. There was an explosion, right? Alan Shaw and Louise Yamato, all those people came in. There was an explosion in technology analysis, technical analysis. So that was my early. Now I took toward technical analysis early because I was a liberal arts major. Right? I have my degree in literature. I started in music. I couldn't read balance sheets. I didn't know what they were. I had no financial background, but technical analysis allowed me to get involved without having the financial background. Funny thing is that I wound up reversing all of that and became totally fundamental, right? But let me just say this, because I've been itching to say this for a long time. I find really kind of useless this whole argument that fundamentalists give about technical analysis. It's chicken entrails, it's reading tea leaves and all that kind of thing. It's a useless argument. If everybody believes something, I better pay attention. It's as simple as that. If everybody thinks that 100-day moving average is going to be an important breakout, if I don't pay attention to that as a fundamentalist, I'm remiss. So I think technical analysis provides a lot of people with a discipline and a substitute for maybe the financial balance sheet knowledge they don't have. I think there's room for everybody, but to say, fundamentals better than technical, or, it's what's works for you best. So I got that.
I'm so happy to give you a platform to share that, to share your message there, Tony. Thank you for that. No, and it's funny because, some of my mentors, Alan Shaw, Louise Yamada, Ralph Atkimpora, and others have shared that in their careers, earlier in their careers, they thought of themselves as chartists because 90% of their time was just updating all the charts or having a team to do it. So back in the day at the Fidelity chart room, they had, teams of people that would just look at Barron's or whatever the source was and be calculating things in an accounting ledger. So I'm very thankful that we're in an era where all of that is automated and we can just focus on our analysis. But I appreciate you talking about that. And I think that, for me, the most successful investors I've worked with understand that balance between good companies and good stocks, right? Between good stories and between momentum or some measure of, what is the chart telling us about the conditions right now? So I appreciate you. I appreciate you mentioning that for sure. Another one of the books that you wrote, which again to date is one of the best titles of a book, and I share with you. Early in my career, I started in the industry in June of 2000, and I remember seeing this book at the bookstore, and I bought it. And probably one of the many books that helped me think about investor psychology and behavior. It's called "Bulls Make Money, Bears Make Money, Pigs Get Slaughtered." And that's just a fantastic name for a book. But it really is sort of like timeless investment wisdoms, right? Sort of Wall Street truisms. And I'm curious, out of that, if you can remember, the process of putting that book together, What's an example of some of the investment wisdom that you think was true when you're putting that book together in 2099 that it still ring true today when you're looking at the markets?
A simple one, don't buy junk. Not complicated, right? Don't buy junk. It doesn't work well. Pennies, options to trade for a few pennies. It's a losing game,
Yeah.
Move toward quality, diversify, decide if you want to be truly rich or comfortable. People who are truly rich concentrate. They also flame out, right? If you want to be well off, you diversify. I mean, you have to make, these are timeless kinds of things. I think the biggest change, and if I rewrote that book today, would be in the financial media, because financial media now is everywhere. People can't appreciate, right? Back in the day, I sound like I'm at the retiree breakfast, but back in the day, you had like Barron's, and that was it, right?
Yeah.
Today, there's just hundreds of these websites, everybody offering advice. So I think I think one of the pieces of advice I had then, I have now, pick your sources and stick with them. Don't go looking everywhere. Just pick your sources and stay with them.
That's well said. I would encourage people to find a copy of that book, because it was well done. Again, I love books like that were not written today but still resonate so much with today. And I'd put that up with many others that
That's
are
very
sort of
kind.
timeless.
Yeah, thank you. That's very kind.
Speaking of things that people should be paying attention to, your latest effort is the Working Profit. I know it's a newsletter that you're using to sort of spread the gospel of looking for undervalued names and looking for opportunities. What's the purpose? What are you trying to accomplish there? And can you give us a recent example of the types of opportunities that you're trying to uncover?
So I retired from my firm last year after 45 years. I was a portfolio director, managing director. And when I retired from the firm, I knew that I could not retire, right? And my work in the markets is a labor of love. I love the markets. I love making people money. That's what I really love. And so started Working Profit as a newsletter-based website. Can I do the advertisement 2 seconds? $195 a year, Working Profit. Just go to workingprofit.com and take a look. Anyway, but I had a simple goal. I wanted to make money for people. I spent my whole career making money for the firm's clients. I got it in my blood, and there's nothing I like better than making money for people. I just do. So working in the market and writing commentary that helps people with their net worth, I think, is just tremendous. As a result, it's a daily thing for me. I probably spend 5 hours a day at it now between trading and the letter. I'm constantly trawling for ideas. So we've had more. Well, I'll just say it. We've recommended 17 stocks, 15 are in a profit. And some of them are very humdrum names like Union Pacific, playing the merger with Norfolk Southern. Then we bought CSX because if they merge, CSX might be forced to a merger. So we bought CSX. Wendy's, Nelson Peltz has bought billions of dollars worth of Wendy's. That's all I need to know. I went to the restaurant. I had the burgers. They were pretty good. The Frosties good. So the food is right. So we're looking for something there. Cooper Industries, Vision. They need to sell the Vision off. The catalyst is there. These are not what you and I would consider to be go-go names. But one thing I would encourage people to think about is that when you look at your statement at the end of the year, and there's a number at the bottom, there's no asterisk that says this was a cool stock and this was a boring stock. It's all the same to it. So I do believe there's fashion and investment. NVIDIA became very fashionable. IBM is still kind of uncool. People don't like the stock. But those are some of the kinds of things where we get involved. British Petroleum, because they're in a process of changing from what they were into something better. And I think all of that kind of thing kind of plays in together. So I think all of that plays. Biotech is something we're working a lot in now, because I think biotech is going to become the next big deal with quantum. And we found a way to use money management more than anything to invest in biotech. So I think there's just so many opportunities. It's just so much fun to get in there every day and just go after this stuff. I just really enjoy that.
Tony, this was awesome. What a fun conversation. We wish you much success with the Working Profit for sure. We'll make sure we include a link so people can get more information about it. Thank you for all you've done over the years to educate investors and inspire people like me to do this for a living. I hope we can continue the conversation down the road. But for now, I say thanks so much for coming on the show.
And it was a pleasure finally meeting you. I knew of you, but finally got to meet you. So it was great.
That was a fun conversation. Thanks again to Tony Gallea of Working Profit joining us on the show today. He mentioned briefly that he was a music major. He was actually studying tuba performance. We did have time to get into it during the podcast, but off camera, we talked a little bit because I studied trumpet performance as an undergraduate at Ohio State. So we immediately connected with that mutual love of music. But boy, talk about a knowledgeable market practitioner and a great opportunity to pick his brain on a number of different things. A number of things stand out in that conversation. First off, I love how he had shared his process, right? And a repeatable investment process. I think when you're talking to someone like Tony, it seems very ad hoc. It's right. All right, we found this one opportunity and here's what, here's why it might make, be a good idea. And this is really what he's built his newsletter around. It's identifying these individual companies that could be potential investment opportunities. But just because you have a process focused on one-off ideas does not mean your process can be undisciplined. You still have to have a structured way of showing up every day to uncover those great opportunities. You still have to have a disciplined process to vet those opportunities and really dig into the details and decide based on the weight of the evidence whether it's a good place for your capital to be today. So I think the focus on process being important was certainly one of my takeaways, and I hope you picked up on that. You picked up on that as well. I mean, someone who literally wrote the book on contrarian investing. It was great to just hear some of the examples of names that he's identified for in his work. Just thinking about companies that are undervalued, what that really represents, and why a catalyst, why some opportunity needs to be there. Right, just a company that's gone down a lot in its stock price does not necessarily make it a good value opportunity. So value traps are very real. What's so funny, he offered up the idea of behavioral biases and a number of the behavioral challenges that he's found investors make, and a lot of the things he shared from his book, Bulls Make Money, Bears Make Money, Pigs Get Slaughtered. Some of that timeless investment wisdom, right, about just discipline and about finding opportunities. And I think a lot of that is just in an effort to minimize the impact of behavioral biases. And also really cool to hear about his early experiences with technical analysis. So many people that have had, that are investing in that window that Tony was, and he mentioned getting his start in the, in the late 1970s. Those Mansfield charts, right? I mean, you didn't have readily available charts, which meant either you had a huge firm like a Merrill Lynch or something, or a Smith Barney that had a chart team, right? A technical research team that would be able to create all these charts by hand, or you subscribe to something like the Mansfield charts or SRC. There's the green book and the blue book. There are a number of services that were basically creating and printing these big binders, and then they'd ship them out to everybody. And those were gold. I mean, those had real value. And it's been so fun over the years to talk to people like Tony who really experienced that and just we take for granted how easy it is to bring up charts of things and think about all the insights we can gain by looking at the visual representation of these stocks' performance over time. And again, it used to be much more inefficient, I would say, when I'm talking to someone like Tony. That really comes into play. I mean, great opportunity to talk to someone also of Tony's experience about the AI trade. And I love talking to someone like him about how to think about this new technology, how to think about the whole, I guess, life cycle of AI, from the producers, the chip makers, the upstream, the downstream, the end users of AI, and just all the challenges. And, he and I talked about how, AI, I think we often overvalue how good AI is right up front. And I think what I found in my own work is exactly what Tony found. And you may, and if you have not realized this, I'd encourage you to think of it, because most of us use AI of some sort in some part of our lives now. I use it as a junior research assistant, but I know, having worked with junior research assistants, they make mistakes all the time. So anytime the AI tells you something, you can't take it at face value. You still have to be a human being that looks at the results and questions them. And I think that is a reality of where we're at with AI today. Maybe that improves over time. I can't imagine it wouldn't. But in terms of where we're at right now, that's very, very important. I mean, a great discussion overall. Great opportunity to talk to someone like Tony, and I want to thank him again for coming on the show. We'll include a link to his website, workingprofit.com. We'd encourage you to check it out because he does great work, and I love the opportunity to pick his brain. I know you'll value the opportunity to learn from him over time as well. By the way, if you want to learn more about the technical analysis tools and techniques we can use in 2026 to identify opportunities, to recognize shifts, and to find some of those beaten down opportunities once they start to show some signs of accumulation, which is what we're always looking for, our Market Misbehavior Premium memberships may be a great opportunity for you to supercharge your decision-making in 2026 and beyond. 3 great benefits to the premium membership. First off, we'll teach you all about technical analysis and behavioral finance through our virtual courses. Second, we'll keep you informed and educated and inspired with our members-only reports, like our weekly flight plan and our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our member community, where you can ask questions, where you can learn from other like-minded investors, navigate these uncharted waters together with a group of like-minded investors. And I'm in there every day, sharing charts, answering questions, and dropping ideas for everyone. So I hope you will join us in the premium member community. You can learn more at marketmisbehavior.com/premium. Hope to have you join as a premium member very soon. In the meantime, thanks so much for watching and listening. Hope you enjoyed the Market Misbehavior podcast today. My name's Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.